We just got the newest inflation data. This is what it says. It says that CPI rose 4.9% over the last 12 months, ending in April. And then it said that core inflation rose by 5.5% over the last 12 months. CPI is the headline inflation number that looks at a bunch of different things. Core inflation takes that CPI broad number and then it strips out what the Federal Reserve Bank calls the volatile numbers. It takes out food and it takes out energy. Now, the reason why these two things are important to understand is because previously the Federal Reserve Bank has said time and time again that they don't care too much about CPI. They look at core inflation because to them, the inflation numbers without the volatile energy and food prices are more important. Well, what we've been seeing recently over the last couple of months is that core inflation has been coming in higher or hotter than headline inflation. And so this is important because we have a lot of media outlets saying that the fight on inflation is over because now inflation has fallen below 5%. But you have to also remember that the Federal Reserve Bank has said again and again and again that they prefer core inflation over CPI. And now let's backtrack and look at where inflation has really gone, particularly core inflation. So the peak of inflation was June 2022. That was when CPI came in at 9.1%. Today, CPI is at 4.9%. So CPI went from 9.1 in June of 2022 to 4.9% today. In June of 2022, core inflation was 5.9%. Today, core inflation is 5.5%. So CPI has fallen from 9.1 to 4.9. Core inflation has fallen from 5.9 to 5.5. So yes, inflation is falling, but we're still very far from the target. Remember, the Federal Reserve Bank's target on inflation is 2%. Even if you look at 4.9 or 5.5, we're still multiples away from the 2% inflation target that the Federal Reserve Bank has set, which brings us to the topic of interest rates and what is the Federal Reserve Bank going to do? Because the way that the Federal Reserve Bank works to bring down inflation is by raising interest rates. The reason why they do that is because inflation is a byproduct of money supply. Because when there's a lot of money in the economic system, when people have money, when people have a lot of disposable income, people can go out and spend. And when you have a lot of people spending, that increases demand. And when you increase demand so quickly, supply doesn't have the chance to increase. And so what happens? The price goes up of things. And so what we've been seeing over the last number of years is there was a lot of money created, a lot of money printed, and a lot of low interest rates, which flooded our economic system with money. A lot of people had the ability to buy things, whether it was cash in the bank or loans or credit cards or something. People had the ability to buy, and supply was here. Now, when people are buying things, whether it's homes, whether it's cars, whether it's sweet green salads, that now increases demand for these products, causing the price of these things to go up, because when you have more demand than supply, the price of an item goes up. And that's what we've been seeing happen. So now the Federal Reserve Bank is working to increase interest rates to decrease demand. Because when you increase interest rates, the cost of borrowing money goes up, which means if you want to go out and put money on your credit card, or you want to go out and borrow money for your business, or you want to go out and borrow money to buy a home, or you want to borrow money to buy a car, now you're going to have to think about it a second time because, well, it's going to cost you more money to borrow money, which means now people will spend less because you have to borrow more money. That's the purpose of higher interest rates. So when people are spending less to borrow money, or when people are spending less money because they're borrowing less money, that means less demand. If demand goes down, well, then that means the price of things don't have to rise as quickly, because now we're not seeing deflation. We're seeing a slowdown in inflation. Deflation is when the price of things fall. We're not seeing the price of things fall. We're seeing the price of things rise less quickly. That's what disinflation is that the Federal Reserve Bank is trying to get. They don't want the price of things to fall. They just want the price of things to rise not as fast as they were before. Now, we did a whole write-up of the inflation report along with what's happening in the economy in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, I highly recommend you do so. It's a free newsletter that you can read in less than 5 minutes every morning, where my team is breaking down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy. It's super fun and easy to read. You can read it in less than 5 minutes every morning, and it's free. I got the link to how you can join Market Briefs down in the description below. But this is where now understanding that even if inflation is falling, if your income is not rising at or faster than inflation, well, then that effectively means that you're slowly becoming poorer. Because even if you get a raise, if it's not keeping up with inflation, well, your earnings, your salary, your income isn't growing fast enough to keep up with the growing prices of things. That's why inflation is such a big deal. And what we've been seeing happen over the last number of years now, especially post-pandemic, is inflation has been rising faster than wages, which means that we've been seeing more and more people dig into their savings to spend money. We've been seeing more and more people go into credit card debt to spend money, because when it comes to the decision between sacrificing the lifestyle or sacrificing credit card debt, more people are willing to go into credit card debt to continue funding the lifestyle, or more people are willing to go into their savings to dig out some cash to continue funding their lifestyle than they are to reduce their lifestyle. And so this is where now the Federal Reserve Bank has been working to make borrowing money more expensive by raising interest rates to reduce the demand for things. That way, less people are buying things. Because if less people are going out and buying, say, homes or cars or whatever, then that gives less fuel for the sellers to continue raising prices, and that gives less fuel for this excess dollars to continue being diluted through inflation. And so now, when we have these inflation numbers, there's a lot of interesting reporting going on out there about what this means for the Federal Reserve Bank, interest rates, and the economy. Number one is, yes, CPI has come down from 9.1 to 4.9. Core inflation is still extremely high. The Federal Reserve Bank has said that they prefer core inflation over CPI. If that stays true, core inflation hasn't come down that much, which means there's more work to be done. Secondly, the next question is, how much will the Fed look at the economic impacts of higher interest rates versus inflation? Inflation is still really high, and the economic impacts of the higher interest rates are starting to become more apparent. They became very apparent in the banking sector when we started to see some bank collapses, because the higher interest rates made the assets that these banks are holding on to underwater, because banks lend money. And so when banks were getting a 3% return on their loans from a couple of years ago, and now loans are 6 or 7%, well, they become underwater on their early loans. And so it puts some banks in a tough situation, because banks are holding onto these bonds. As interest rates went up, the valuations went down, etc. I made a lot of videos on the banking sector that you can watch to understand exactly what happened there. But the higher interest rates put a lot of banks in tough situations, which made them collapse. That was a concern for the Federal Reserve Bank. And we're still going to see more issues in the banking sector. The issues in the banking sector are still going on. So that's one issue in the economy. The second issue is non-bank businesses. So obviously we've seen the pain in the startup economy. That's been happening since last year. But now we're starting to see a different trend. And this is a similar trend that we've seen happen in many different economic recessions. In 2008, in the dot-com bubble bursting, what we see happen is the first industry to really slow down are advertiser-supported businesses, meaning companies that rely on advertisers and sponsors. So in the past, these were like newspaper-type companies. Anytime we saw economic slowdown, these media companies would be the first to go, because you rely on advertisements. Well, when you see an economic slowdown, or businesses are worried about an economic slowdown, what do? They want to hold on to their cash. So they stop spending money on ads. And that's exactly what we're seeing happen right now. We're seeing a lot of layoffs in the media sector. We're also seeing more bankruptcies in the media sector. BuzzFeed News declared bankruptcy. Vice News said that they're going to go bankrupt. We've seen a lot of major media players announce layoffs and hurting revenues because advertising dollars are falling. Why are advertising dollars falling? Because businesses want to spend less money and they want to hold on to more money. I mean, I can tell you from experience, even here on YouTube and with Briefs Media, my newsletter company, advertising is changing because businesses are being more cautious. They want to be more frugal, and they want to be just more careful with how they use their money, because people are concerned about what's going on in the economy, and they want to hold on to that cash just in case things do get worse. And so we're seeing a big shift in the advertising space. And we've also seen, the effects of companies like Bed Bath & Beyond. But this is where now the Federal Reserve Bank is going to be meeting in the future, and then they're going to look at this latest inflation report, they're going to compare it to the economy, and then they're going to look at the jobs numbers. Because right now, today, unemployment is at the lowest rate that we've seen in over 5 decades. And it's interesting because we're starting to see a slowdown in the economy. Factually, the last GDP numbers came in at 1.1% when they were supposed to come in at 1.9%, or what people thought would come in at 1.9%. So the economy is slowing faster than expected. Inflation is still extremely high. And the Federal Reserve Bank, by their mandate, are supposed to only look at 2 things. They're supposed to look at unemployment, and they're supposed to look at inflation. Today, unemployment is at some of the lowest levels we've ever seen. Inflation is still extremely high. Based off of these 2 factors alone, based on the Fed mandates, this would say that the Fed needs to continue being aggressive. But now what we're starting to see happen, this started happening over the last 2 to 3 months, the Fed started saying, we're not just going to look at the data today. We're going to start looking at the data today, and then we're going to predict where this data is going. So the Fed could say, well, unemployment is really low, but we think unemployment is going to tick higher. And if unemployment ticks higher, that's going to slow down the economy even more. So maybe we shouldn't fuel the higher interest rates so much. Or maybe they'll say, you know what, yeah, unemployment is still really low. It might go a little bit higher, but the inflation is still too high, so we need to continue raising interest rates. And this is where what it looks like is the fight on inflation is not over. And that means the Fed is going to have to continue being aggressive to bring interest rates higher if they want to bring inflation down. Now, could they flip? Absolutely. But the inflation fight is absolutely not over. You can just look at the numbers and see how sticky the core inflation is. In order to bring inflation down, the Fed will have to get more aggressive on interest rates. Will they? I don't know. If they don't stay aggressive on interest rates, inflation could start going back upwards, which would also cause more pain in the economy, because when people don't have the ability to spend, because if inflation is higher, people have less ability to spend because all their money is going on their groceries and their rent and their travel costs, so they have less discretionary money. That also hurts the economy. So we got the inflation data. We'll be keeping you posted on market briefs. Now the question is, what's the Federal Reserve Bank going to do based on this data?